Okay, good afternoon, everybody. Today is June 17th. It's Friday, 1:15 Pacific time. Markets are closed. This is the weekly take on the market. I will be your host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Here's the disclaimer. I'm not licensed. Nobody at IBD is licensed. So we don't make buy, sell, hold recommendations. We try to stay in our circle of competence, which is research and education. All right, thanks. We will do the usual. We'll talk about the markets. We will go through the industry group, some stocks to watch, and then the quote of the week. So let's jump right into the markets. Let's pull up MarketSmith. And you should see a chart of the NASDAQ composite. So, we're in a downtrend. It's a bear market. I think that's pretty obvious to everyone. We're waiting for, some type of change in direction, follow through day. If we had a follow through day, I just don't know what I would buy. There just isn't any merchandise that's setting up. So it feels like the market needs time to repair the damage. There's been a lot of damage, as we all know. It's under the surface. The S&P is, I think, down 20 some percent. Very, NASDAQ maybe it has a 30, maybe, but it feels worse. Like I was talking to Arusha, and when the selling was relentless, was it yesterday? And I was like, it feels like the market's down 50%. Like I feel like I should be putting money into mutual funds, like long-term mutual funds. But what bothers me is, the S&P is only down 20%. If I start buying mutual funds and the S&P goes down 40%, I don't know. I know myself pretty well. I'll probably be puking. But you can see Fidelity Contra is down. Well, 19, let's say 19 on the high and 13, so 6 divided by, it's down 31%. And that's held up, fairly well. T. Rowe Price New Horizons, I think, is probably down, let's see, I would guess around 40%. So let's just use 85 down to 40, 45, just give it the benefit of the doubt. And you're looking at 47%. So this is really, much worse under the surface than the indexes. And then we all know the story with ARK, down 70%. That would be a lot. So we're waiting. It's possible the market's, trying to put in some type of low. I don't really know. I'm open to anything. I'm lightly invested just because I think the market could go either way. It wouldn't surprise me if it was 10% lower from here or 10% higher. I just don't have any way to really gauge or measure, the risk reward as we sit here today. Let's pull up the S&P. I'm sure it's not much different down there. And let's pull up the Russell. Not much different, undercutting the lows. I'm not a bond market expert. Here's the TLT, which tracks long-term bonds. And it really, I think, for the market to have any kind of legs to go sideways, we really need bonds to kind of stop going down. And that's I guess the only positive I can see is that they've kind of stopped going down, but they've just gotten hit really hard this year. 27% off at 2-week high. I think this is bordering or is, although the year's not over, the worst year ever for the old 60-40 split. It's very rare for bonds and stocks to have such a poor year in the same year. At least in the crisis or in 2000, your bond portfolio would offset your losses at least a little bit. Now there's nowhere to hide. Gold doesn't go up, crypto's on fire. I don't know where you would put your money in. So right now it's just kind of return of your money versus return on your money. there'll be a better spot for return on your money. And then, as far as the short side, it's appealing, but the problem with the short side, it's very difficult. You can see how the market, it doesn't work the same way to be short as it does to be long. So let's reverse this. Let's go all the way back to this year, 1.7. And let's say you're bearish, which I was starting to be, because just the underlying factors were not that good. And you had a divergence. So here's the S&P making a new high. And here's the NASDAQ, no new high. So there is a negative divergence, which sets alarm bells off for me. And there was a lot of stuff that looked poor. And we just gone through this mania, this wildness of NFTs and crypto and SPACs. And when they write the history books, we're all going to look back and see it was so obvious. But when you're going through it, it's just impossible to know when it's going to end. But this is nothing that hasn't occurred in stock market history. I remember the internet bubble very, very clearly, and I had friends who one of my friends, his wife worked for eToys, and he was super excited about all the options she was getting, and I didn't have the heart to tell him that the odds were really, really high, like bordering on almost 100% that she would never see a dollar of those options. But so I just kept my mouth shut. It's better that way. But that's what happened. A lot of that stuff just incinerated. And now we're kind of going through the same thing with crypto and SPACs and all of that. So you get this undercut here. And so if you're thinking, oh, the market's going to go down, and you short this low, well, you were right for half a day. And then, 2 days later, it seems like nothing, but that's, I would bet that's about 5%. So 14,530 is the low to, 15,158. It's 4.3% right there. So it's hard to have conviction. The market doesn't look that bad, and you got a rally of 4%. Next day, now you're down 5%. Next day, it breaks finally. So if you somehow survive that, but you can see how hard it is to short like undercut of lows. So let's fast forward a month, and you make this low, and you start to rally. This is when you need to be shorting on the way up in a bear market. But the problem is, if you short there, you've got a couple of days of pain, then you think you're okay, and then you have another really bad day of pain. So it's hard to put shorts on like that. You almost have to ladder in just a little bit, a third, based on your position size. So let's fast forward almost a month. And, you get short, you undercut the low, and just a rip roaring rally. You see the theme? You cannot short undercut lows. They just, the probabilities are super low that it'll work. It might work, but the probabilities are very poor. They're not in your favor. You don't want to do that. You want to be covering these lows. You want to be shorting up here and covering when it breaks the lows, right? I think somebody calls this shorting in the hole. You don't want to short in the hole is what he would say. A guy I follow on Twitter. I got that term from him. So you undercut the low, you rally, and then you undercut the low again, and then you just get an amazing rally, which just, even if you were short here, this rally will knock you out of the box. It's just too strong. If you've ever been short, this is a lot of pain, immense pain. Even if your prices are all up here, it's pretty hard to stomach something like that. So you can see how you have to be hit and run. You have to pick your spots to be short, and then be willing to take it off and wait for the next opportunity, knowing if it waterfalls, you might miss that. But that's okay. At least you still have your capital, and the big money's made being long. I'm just trying to survive on the short side, So let's advance to May 1st. You can see how if you shorted there, you'd have got stopped. Maybe you'd have to try again, short there, short there. So you want to short it on the way up into these moving averages. You undercut the lows. You cannot be shorting here. You just cannot. Yeah, I know it could crash. And that's all, maybe. When has it happened? In 1987, what are the odds of it happening again? So let's advance just a day and see what happens. Up, advance another day, up a little bit, and then the third day you're run over. You're out, you're knocked out of the box being short. So you cannot undercut lows, short undercut lows. Let's advance to this little rally. And this one was a little bit easier from the short side, right? You run up, the moving averages are here, and then you get this bad day. Now, that was a Thursday. You're breaking down. It feels like the rally is over, but you have the CPI number on Friday. So you have to know that that you've got this exogenous event that could move against you really poorly. But that's a good setup to be short. I think the probabilities are in your favor when you have something like that. And then it breaks really bad. And I think that's a Friday. And then it breaks again. And this is where I'm covering those shorts. Now, it looks terrible. If this was a stock, I wouldn't be selling it. If you turn the chart upside down, I wouldn't be buying that. I'm sorry, I wouldn't be selling that 3 days out of that little area. I might think it's going to pull back, but I wouldn't be too worried about giving back my gains. But on the short side, I would be. So I would cover that day. And, maybe it does go lower. It did after a couple of days rally, but you get the idea. So really what I'm hoping for, if I want to be short, and I don't really know what to think here, but is something like that. Something like that. And if it gets to that, I'll cover and take the loss. And then the next opportunity will be something like that, further up the roof, further up the, further down the timeline and further up the price. So that's my 2 cents on shorting. Very, very difficult endeavor. All right, so let's couple of things I noticed. This tweet from Jason Gepfert, I hope I didn't butcher his name. More than and this is on June 16th. So more than 96% more than 90% of the stocks in the S&P declined today. It's 5th time past 7 days since 1928, been at zero precedence. So the market's getting hit really, really hard. The good news with this is I don't have to hear about, the 4 other times the market did this, you were up 42%, 9 years later. We're not going to hear any of that because there are no precedents. So that's what the market does. It just does things that people think can't happen, and that's how people get in trouble. I'm open, have the imagination that anything could happen. I think the market could go up and make new highs in the next 12, 18 months. I think the probabilities of that are super low, but I know that's a possibility. They're not zero. And the market could go down a lot from here in a hurry. I think the probabilities of that are really low too, but it's not zero. So I always have a plan for something crazy that could really wreck me if I'm not in sync with the market. Even though the probabilities of that happening are very low. Jared Dillon tweeted, I wish I could have got the whole tweet of his. I guess I could have double printed this. But anyways, he tweeted about Goldman saying that oil prices could go parabolic on June 8th. And we'll pull that up. And he says one more for the files. What does that mean? It's a sentiment, right? When people, after oil has gone from negative 35 to 135, and now they tell you that prices can go parabolic, you're late in the cycle. There was 0 people out there saying oil prices could go parabolic when it was negative. Nobody thought that. Now that it's 135 on this day, I think it was around 135. Now everyone, they could go parabolic. Reality is they've kind of already gone parabolic. That's why they say that. They're just kind of telling you what they see. So I actually retweeted his, said contrarian me is very nervous energy stocks. Oil was up big that day, and the oil stocks were soft. They were not going up with the price of oil, and some of them were even down. So that was June 8th. So let's pull up the USO, which is not a great proxy for oil because it is an ETF that's buying the front month contract all the time, but it's not terrible. So that's June 8th right there. And you can see on that day, oil is up 2%. And let's pull up the XLE, which is the Energy Select ETF. And lo and behold, that's June 8th. Incredible. And I actually shorted XLE this day because I had energy exposure. And then the next day or the day after, I just covered it. I just covered it and just sold all my energy stocks. I don't like to hedge. I think I find hedges are very difficult. The best hedge to me is to sell. So since I was nervous about energy stocks, felt like they could go down, the sentiment was really strong for them. They'd been the best performing group for a long time. They'd made a big move. Put all that together, and the probabilities were high that this was going to happen. Were they 100%? No. They felt like 60, 70, 80%. Felt like really high that we were going to get some type of correction. So I just got out of my energy stocks and covered the short. Now, wish I'd stayed short, but the objective was it was a hedge. And again, I don't like hedges. If I had stayed with the hedge, even though this is a big move, my oil stocks went down a lot more. I'd have lost. So that's the problem with hedging. How much XLE do I need to short to cover the exposure in these other smaller names like FLNG, which I was in, GLNG, which I was in, PXD. I just would not have covered all of this carnage that's happened. The VAL, the driller, NBR, which I bought that day, hoping it would be a handle, and sold it the very next day. You can see that was the top for this one was June 8th, right there, at least the top in this route. So energy's been the best group, and there's no place to go anymore. So that's why I don't know what's going to lead a potential rally. I just don't see any leadership, but we'll dig into the industry groups and see. So that's how I like to use Twitter, is to look for that kind of sentiment. Now this guy was, he's doing kind of the same thing as me. So that's why I follow him, because I'll let him do the work for me a little bit and then just kind of feel the tea leaves. But I find Twitter is a great place to get market sentiment and just feel the pulse of the market. Are people nervous? Are they scared? Are they wildly bullish? Are they running around buying NFTs? You just know. If you're a student of history, there's some great books on market history. There's one called Bull by Maggie Mahar, Mahar, which is very good on the 2000 bull market, the top of the 2000 bull market. And then the author is Lowenstein. Where is his book at? Sorry, I have so many books. Gosh, I can't remember where I keep his book, but the author is Lowenstein, and it's I'm fairly certain it's Lowenstein, but it's a great synopsis of historic bull markets and collapses. Japan, tulip bull mania, which we all hear about and read about, where they're buying and selling tulips, and et cetera, et cetera. What's the name of his book? It's killing me now. He wrote When Genius Failed. So I have a feeling I might be messing up the authors, which is why okay, good. I'm sorry. Lowenstein's book on When Genius Failed is about the long-term capital collapse, which is a very good book as well. But the author is Chancellor, and the book is Devil Take the Hindmost. That's a good book on reading about market history. And there's others there, but those are the two that jump out at to me. And really all this is just this. It's who I think I used the term before. It's the same one act play. They just the characters are changing, and I feel that it's amazing how I feel like I've seen this before. I know how this ends. I don't know when it ends. I don't know what the repercussions are, but it's going to end. And being a student of history will help. Now, I'll caution you that it will hurt you a little bit, the fact that you'll probably recognize these signals sooner than most. So you have to keep that in mind, that this bear market that we're incurring, I felt like was probably overdue. So like 21-ish, and 2018, when we had the little hiccup in the market. So here's 2018. It could have just as easily occurred then. Powell was raising rates, trying to raise rates. The market was puking on itself, and then he pivoted. They call this the famous Powell pivot. If he didn't pivot, it's likely that this bear market we're encountering would have occurred here. And then you fast forward, here's the COVID bear market, and then, the intervention there. And, you just get this kind of overthrow rally. So you have to be flexible, to what's going on, be willing to change. I can be all the, negative about the big cycle here, but fully long pedal to the metal, because I know I have a plan to get out if it changes. And it's not going to change on a dime. Something like this takes a long time to occur, and you see how it did for a number of weeks before it finally rolled over. All right, so let's go to the industry groups. Let's go ahead and sort this. Energy, coal is one. Interesting, holding up pretty well. Oil and gas. Now, they're going to stay up here for a while until something tries to take over for it, or maybe they stay here if the market continues. Shippers. Do we see anything that's really jumping out? And I'll do this weekend. I'm going to look for something that had a big number here. Oh, wow, food, meat products. 113, 32, 20. That would be beverages, alcohol, 121, 37, 26. What kind of product, what kind of groups are those? Are those high growth groups, right? No. Medical outpatient care, 142, 44, 38. So that might be a group that I go through and look, and so on and so forth. So I'm looking for big numbers here that are changing to here, and I usually don't go past 40. I'm not so much worried about 190 that became 160 that became 120. I'll wait. I'll let, if it's real, it'll get to 40 sooner or later. So that's how I would review it. But the groups are pretty much the same. Stocks to watch. There just isn't a whole lot. Like I said, the energy stocks. These stocks have rolled over. It's hard to know if it's the end of the game. They've made big moves off the low. This is 60 to 300. That's a five-fold move. Now this is off the low. The first real base, I think, is here. So that's stage one. Stage two is kind of a base on base. That might be a stage three. Let's turn on the pattern reg. Is that long enough? No, not quite long enough. So 1, 2, it's still possible. And these stocks have great earnings and sales. So maybe this is the area to go to, but I don't really have, I mean, shippers have kind of given up their gains. There's Zim. I guess we can look at Tesla, just looks tired. There's no base. A lot of pink in here, right? Look at all the pink weeks in there. Just a lot of distribution versus on the way up here. Look at the number of weeks up in a row. 1, 2, 3, 4, about almost a dozen blue weeks. It's kind of changed its stripes a little bit. Apple, type too fast. Again, look at all that pink. Wow. What's that? 2, 4, 6, 8, 10, 12, roughly 11 of the 12 weeks are down. It's under distribution. Stocks under distribution. Amazon. Right. So I just don't know where you would go if you had a fall today. So that's the main takeaway, I guess, that I'm experiencing in the market. I don't want to be short either very heavily. I'm short a little bit, some names, but I'm nervous when we undercut those lows to be short. So I think this is a time where you just let the market play out a little bit and see what can happen. All right, so let's go to the quote of the week. Stanleydruckenmiller was on, I think it's the Sohn Investment Conference, SOHN. I would do a YouTube search for Sohn 2022 Druckenmiller and watch his interview. Stanley, I mean, most of you probably know, but Stanley Druckenmiller is probably, he's the Michael Jordan of investing. Now, are there other people who have made better returns than him? Sure. But the type of returns he's made on the dollar amount that he managed, the combination of that, there's very few out there that have matched him from a discretionary standpoint. I know there's Renaissance and others that have done super well, but I really like listening to Stanley Druckenmiller and his thought process. So he had his own fund, and George Soros recruited him, and people ask him, what did I learn from George Soros? I thought when I went there, I was going to learn what made the yen and the Deutsche Mark go up and down. Remember, he's been in the game a long time. The yen still exists, but not the Deutsche Mark. What I learned was sizing is probably 70 or 80% of the equation. It's not whether you're right or wrong. It's how much you make when you're right and how much you lose when you're wrong. You'll see a lot of the same thought processes and same quotes from Warren Buffett, William O'Neill, Stanley Druckenmiller, Jim Rogers. I could go on and on. Yet they all have different styles, right? But they're all trying to do exactly what Druckenmiller says here. When you're right, you want to make big money when you're right. And when you're wrong, you want to lose a little bit of money. And you don't have to be right that often if you do that. You could make money in the stock market being right 1 in 10 times. If every time you're right, you make 100%, and every time you're wrong, you lose 5%. Let's say you're wrong 9 times 5%, that's 45%, but you make 100 on the other one. So you net 55%. And it's not that, that math isn't exactly perfect, but you get the idea, right? You were right 1 out of 10 times and made really good money. Psychologically, I think that's difficult because it's hard to be wrong 9 times and then do that 10th trade. I find. So I like a strategy that, it doesn't have to be right that often, but I don't think you need to be right, even half the time. I think you can make really big money being right 40% of the time. So you have to have size when you're right, and make as much as you can, take something out of it. It's gotta make a difference to your portfolio. And I don't know what that number is. I think it's something where you can handle the volatility. So you need enough of the stock that goes up so that if you're right, it makes a difference to your account. It moves the needle, but not too much that you can't handle the volatility and you do the wrong thing. And it's different for everybody. But that's this game. This game is all about sizing. It's not about guessing where the market's going. It's not about knowing where the great macro trade is. You put your chips down, you look at the probabilities, and if you get it right, you want to make $3, and if you get it wrong, you want to lose $1, and just try to rinse and repeat that process. All right, last but not least, I know a lot of you have registered for the event tomorrow. It's really cool. There should be a ton of people on there. It is live. It is not being recorded. This is the first one, and if it goes well, whether the the response of the show rate and or the feedback we get, if I somehow pull it off, it'll be a little bit like this. I don't have a script. I don't have anything. I'm just gonna open up my Mark Smith. I have kind of an agenda where I'm going to go through, and I'm going to show you guys. This is how I would do my research routine. This is what I would do on the weekends. We'll try to cram a couple hours into, 45, 50 minutes of research. So hopefully some of you will join tomorrow. If not, I apologize. It's not being recorded. Like I said, if it goes well, we will do one of two things and maybe both. We will have another one. I will pick a different time. That way it might be more convenient for our international clients, because I do realize that time is not great for international clients. Maybe later on in the evening, 5 o'clock Pacific time, 8 o'clock Eastern. I don't know what time that is. Maybe it's 7 a.m. London or something like that, but maybe we can accommodate those clients as well, and we'll do it again. All right. Have a great weekend, everybody. It's a long weekend. The market's closed Monday, so enjoy the 3 days. Contact information, marketsmith@investors.com, 800-831-2525. Thanks a lot for your patience. We really glad that you guys are watching this. I wish I could cut it shorter, but I just love to talk markets. So you're stuck with me for a half hour at this point. So I appreciate your patience. Have a great day, everybody. Bye-bye.